So now let's come to the Ask Weekend Investing round. So what is Ask Weekend Investing round? We basically call for any kind of queries from our users or anybody who follows us on Twitter, and any query regarding the markets, regarding products, regarding any uh, dynamics of the market are attempted to be answered. I don't claim that I know the answer for everything, but I do try my best to answer them to the best of my ability. We've done 43 such rounds before. 731 queries have been answered. All these videos are available for your review. If you wish to go through them, please see the description. And of course, please do subscribe to the channel if you haven't. Uh, and certainly, we are not going to charge you for this. Atul has the first question. What is your view on the theory of reversion to mean? If you believe in the same, and then considering the very good performance of the last 5 years in small and mid cap, what is the likely output for your products in the next 2 to 3 years? So the likely output is certainly, the last 5 year performance is difficult to repeat in the next 2 to 3 years. But that does not mean that they will not perform or the markets will not perform. The kind of growth that we have seen in small and mid cap perhaps is touching 25 to 30% CAGR even on the small cap and mid cap index. That certainly is difficult to continue in the next 5 years. And hence, there is some reversion to the mean that will happen. Reversion to the mean also does not mean that all the next 5 years are going to be dull. It may so happen that one year may just be a very dramatic year, and then you have 4 nice years after that. So all options are on the table. Uh, the only thing that you need to worry about is whenever the market will do what it is doing, are you able to navigate that or not? So I'm basically hoping that the strategies will be able to navigate whatever is thrown at them, and certainly we look forward to a nice result at the end of 5 years. Siddharth says, what are the pros and cons of a sectoral fund compared to a momentum strategy? For example, it is tempting to go for the defense theme at present. Why should I consider momentum over a defense themed fund? Help me clear my confusion. So there is nothing wrong with a sectoral fund. Sectoral fund gives you a very nice concentrated opportunity to invest in a sector. The problem happens where you over own a sectoral fund. So let's say you have 100 rupees and you put 75 rupees in a defense theme, and if the defense theme goes a bit soft for the next 2 3 years for whatever reason, then a significant part of your portfolio will be a dud for that much period. Whereas if you are in a structured momentum strategy, it will take a hit and get out of defense and go into something else. So as long as if you are having a portfolio of your own where you are saying, okay, I am tactically allocating something to a sectoral fund, but I know that other things are also there, and I will have a mechanism to figure out when to get out of this. So just buying is very easy. Buying of anything is very easy. Any stock, any sector, any strategy is very easy. But exiting is most difficult. So figure out how you're going to exit. Let's say today you buy a defense theme fund. When and how are you going to get out? That should be clear to you. Is it going to be so much profit, or I'm going to follow up and trail the profit? Or if it starts to go down and the defense theme fizzles out, what am I going to do? So I think that should be clear to you. If not, go for a momentum strategy where automatically the fund of the season will appear in your investments. I hope that clears something. Ajay says, what are some of the psychological biases that you experienced in your early trading and investing days prior to momentum? Can you give some examples? So I think I've had all kinds of biases before I arrived at this uh, style of investing, and which I was basically doing for myself. And this public service just happened to be an extension of that. So from 1996, when I started my career as a stockbroker, I was trying investing in various formats. Earlier, in the first many years, I tried to do value investing. That is the first thing that you feel that you are really good at. I failed miserably at that. Um, Stocks that had high price earnings or high, very expensive stocks, they were the ones which did the best, provided you were able to get out of them also. So that initial days of the learning was that not to really uh, go after basically a confirmation bias from whoever is around you. Everybody is doing the same thing practically, and they are confirming that buy the top FMCG stocks or buy this. So that I did that for maybe 4, 5, 6 years. Then the market really tanked very badly after .com in 2001, and then there was no business virtually till 2004. Nothing was moving, so I was very disenchanted with the stock. So that was sort of another mistake. I don't know which bias it will correspond to, but to sort of give up on investing. Then 2004 to 2008 was a bull run, and everything that one was buying was going up. So one felt extremely overconfident about one's approach. That you think that you are having that skill to pick stocks. So a lot of demerger trades I was doing at that time, trying to extract value from some of parts. And then I got into this very concentrated bet, where I bet on a demerger where I thought a lot of value would get come out, and I probably bet more than half of my net worth on that. And that stock never got listed back on the exchange, and I lost significant amount of money there. So I think post 2008 crash, when I look back, I said, I've been in the market for almost 12 to 13 years, 14 years. Every time I make significant money, I lose most of it. I was gaining. It was not that I didn't make anything, but it was nothing, of the kind where which would make me happy at that time. So then I started to sort of think about how to remove any external inputs into the investing and strictly follow price, because I realized by that time that my emotions caused me to take a lot of poor actions. Whenever my stocks were tanking, I would exit them in fear, because I did not know, there was no structure around that investing. So I started to look at structure. I started to look at what actually is doing well in the market and some ways of getting out of it at some point. So no attachment, no confirmation from anybody else. It's a very alone trade actually that you need to do. Whenever you will have like a group trade, you will have a lot of confirmation bias also. So, and earlier, of course, a lot of anchoring used to happen. I'm not going to sell below this price and this and that. So, all those biases were out of the table when, one started to look at a very, very systematic way, simple way of approaching stocks and investing in a portfolio format, but not having any attachment. So, basically, the money that you put up, I mean, I'm, I don't, I always think that, I could lose significant amount of it. So that with that kind of sort of that detaches you a little bit from that money when you are prepared in your gut for the worst outcome. And then that I've built basis that gradually with a lot of asset allocation also. So I think that has been my journey. uh, I hope some lessons can be derived out of that and some biases were smashed. Rajesh says, I have two products invested 30 each. Should I keep monthly SIP increasing both, or should I add a new product of yours and build by a SIP? So I really can't, give advice as per my license. Uh, what I can, of course, say that don't overbuild in any one product. If there is a recommendation that build up to a certain size, I would not want you to go beyond that size, because otherwise, whenever you will do some a market order, some slippages may start to happen, etc. So build up to whatever size has been recommended, and then of course there's always a possibility of adding a new product, or you could go into products which are catering to higher uh, capacity. So you could look at the HNI products, for instance. Richa says, what's your predicted gold rate for 3 to 5 years? What are your sectors for the next 2, 3 years? So, Richa, I'm not a prediction oriented person. I follow markets. I don't predict markets. I don't think I have the capability or the knowledge to predict markets. And I also think that most people don't have that. A lot of people may claim that they can predict markets, and nobody really can. So I don't get into that game of prediction, because I also know that 99% of the times most people are going to be wrong, including myself. So, in terms of then gold rate for 3 to 5 years, what we can do, however, is to try to translate what has happened in the past. If that happens in the future, what may happen. So, last 50 years record for gold in INR terms is 11.5 to 12% CAGR. So you can build that in a sort of a extension of the price, that in the next 5 years, if we were to grow at 12%, where we will reach, and you can do that math. uh, Gold now has a more important position in the current monetary system, like we have. So there is a significant amount of potential that we will cross that growth rate if you were to create the a best possible scenario for gold. In terms of sectors, I really cannot say what sectors will do well in the next 2 to 4 years. That is the whole idea of not having a fixed mindset towards any sector. Whatever sectors will do well will appear in our strategies. That I'm very confident about. That we will be picking the best sectors going forward automatically, and will drop the sectors that will not perform. So I really can't say what sectors are really going to do well. In general, I think the financialization of the world has happened quite a bit, in the sense of a lot of financial products and the valuations of them are there, and the commodity side of the world has been left behind. For instance, oil is at the same price today where it was 25 years back. That really does not make any sense to me. For instance, the value of money today versus 25 years back has dramatically changed. What kind of inflation that we've had. So there are certain sectors like that which can get revalued over a long period of time. Whether that will be the sector for the next 2 to 4 years, I don't know. But I'm just saying that a lot of things have got very expensive, and then a lot of things are very cheap also in the world. And that may sort of rebalance over a period of time. Gold probably is doing that right now, where it had gotten very cheap versus a lot of things. Also, while we are at this question of gold, there is a school of thought that you can't really think of gold in terms of fiat currency. So when we say gold is so many dollars per ounce, actually gold is where it is. It is the dollar which is depreciating versus the gold. So ideally, you should be valuing other things in gold. So many dollars required for 1 gram of gold. But that's a very long and involved kind of a subject that we'll get into. So this is where I'll leave this question. Sajan says there seems to be a lot of chatter around silver too, alongside gold. I know you only talk about gold, but I want to know your primary thoughts about silver. Should I consider silver alongside gold, or is gold sufficient? So, silver always has had a significant role in precious metals moves, but silver is a very difficult commodity to invest and trade, because it just doesn't move smoothly. It's a very, very volatile commodity. It'll move once and then it'll not move for 20 years. So that it becomes very, very difficult. If you go back and see the silver chart, we've not taken out the silver highs for I don't know how many decades. So it becomes a difficult trade. In rupee terms, it is still not so bad because we keep depreciating against the US dollar. And every time gold has a rally, silver does participate along with it. And it is going to give very sharp moves whenever it does. So that part is certainly taken. Now, why I don't talk about silver is because I certainly don't have as much knowledge or even interest in silver. Why? Because you need to understand why is gold important. Gold is important because it is a part of the monetary system today. Central banks hold gold. Central banks are not holding silver. The day they start accumulating silver also, I think silver will become equally important, if not uh, lesser. So until such time that silver gets that mandate that yes, it is not just a commodity of which you will make some, which will be used in electronics or some other things, like platinum, a lot of other metals are also there, but they're not part of the monetary outlook. So it is very different classification of gold that we talk about, and hence I don't want to compare also the two together. But if you are having gold and if you are having allocation, that is sufficient. If you want to trade and you want to enjoy some sharp rides, then perhaps you can try to trade silver. But in general, I would say silver is something that is going to frustrate you to nobody's business. That kind of a frustration is there in silver traders. Sam says, I'm your regular listener on YouTube and thank you for sharing experience, knowledge, and thoughts about the market. Would I subscribe to my 20? My request is to suggest the best gold fund for hedging, balancing my portfolio with my 20. So that's a great way of looking at the markets to have a good hedge also to balance your portfolio, especially with small and mid caps. So I would suggest I've used two gold ETFs, the Nippon ETF and the Zerodha Gold Case. Both are, in my view, exceptional companies as well, very well respected. And there are others as well. So I'm not saying others are not, but these two I have personally used, and I think these are good products. So, but do please do your due diligence because I don't want to be caught recommending anybody. That risk has not on my head. Dr. Gandhi says, where does Nippon keep its physical gold? So I did call up both Nippon and Zerodha and talk to their management. And their gold, according to them, is kept in custody with their custodians. There is an annual report, custodian report, that is available in their offices. They say that you can come to our office and we can show you the audit report, and these audit reports are also submitted to the regulator, I believe, periodically. So it is kept in a custody of some, I'm, and most of these custodians are like the bigger banks, etc. So I'm hoping that it is safe. uh, Soyal says, how feasible is it to present rolling return metrics regularly to help viewers better understand the consistency and risk adjusted returns, especially for gold? So I'm sure there are a lot of uh, websites or places which are showing you, these metrics. We don't have a specific gold product to really, bring out these metrics. But for a longer period of time, I mean, the average CAGR on gold has been about 11.5 to 12%. Uh, and I'm sure there are websites which show you rolling return metrics or risk adjusted returns. And risk adjusted returns will be very nice for gold wherever you are able to find. I'll try to find and tweet on this if I'm able to do that. So we are at the end of the Ask Weekend Investing round. Good queries today. Thank you so much for chiming in your queries. I'm sorry if I'm not able to take your query today in case it has been missed or we've run out of the time. Do send us a mail in case it is a burning question that needs to be answered quickly. We will certainly respond to you on email. And of course, in case you want, you can go through all these episodes. It's a I would say, gold mine of repository of answers there. Some right, perhaps some wrong as well. But do go through it and let me know your experience. Thank you so much for watching our channel. Do subscribe to our channel. Give us some of your feedback, whether you like it, don't like it, some things that you may want us to change. All that really goes a long way. Thank you so much and have a good weekend. Bye.